Hey there, gang. We'll get started in a couple of minutes. Go ahead and record. So just so you know, I'm going to be recording the class. I'm going to put the recording up so you can review it, and or if you don't happen to make it to a lecture, you'll be able to watch the lecture. Okay, so we'll try this. If this doesn't work, then I'll revisit and try to come up with an asynchronous methodology, which would mean that most likely I would record short videos and then put up some sort of problems for you to do in between videos, and you would just do it all kind of on your own at your own time. But then it wouldn't be directly interactive. So a couple of other points. So one thing I would say is if we are going to continue to do synchronous, meaning live videos, then you should really try to be here and be on and paying attention. Because I think, you know, my experience with stressful situations is it's best to try to maintain um, normalcy as much as possible. So we've got this schedule. We're going Monday, Wednesday. You know, that is going to be that will actually, I know it may seem like a nuisance to have to log on at the specific times, but, you know, I think that's actually going to be good for you, good for me. I think good for all of us to maintain some degree of normalcy in this wacky and weird time. Okay. So we'll keep trying. So do try to be here, you know, use the recording as a kind of a, you know, really do try to be online when we're doing this. Don't say, oh, I'll just watch it later, because, you know, all good plans rarely come through, right? Okay. So today, as we go forward, I've got a bunch of notes I'm looking at over here on my other screen. So today, as we go forward, I'm going to start using Excel. So what I'll do in a minute is I'm going to flip to Excel. I'm going to share my screen so you'll be able to see my Excel work, and my camera will be kind of off to the side here, so you'll see me you'll see a side view of me as I'm looking at my screen, which is actually over here. And I'm going to work talk and work in Excel to show you kind of how to do some of this work in Excel. My thinking there is, and I've always wanted to kind of bring finance into the Excel realm rather than working with calculator and paper, because in reality, when you go out to the field, if you work in any sort of finance, you're going to do it in Excel. You're not going to do it on paper, except, you know, when you're doing some sort of back of the envelope kind of calculations. So I'm going to start showing you how to do stuff in Excel with the idea that, you know, so if you're at your computer now, you know, you can open up an Excel sheet, or everything I think we'll do, at least today, could also be done in Google Sheets. So if you are more comfortable with Google Sheets, you can pop up a Google Sheet and you should be able to follow along and do stuff. So I'll be doing it, and then I'll give you a second to try to copy what I've done. I think that'll be a useful way to work, but you can give me some feedback, okay? If I do some specific things that I think are technical, I'll probably record some shorter videos, you know, 5-10 minutes. Hey, let's look at exactly how to do this step by step. I'll try to do that if that seems to be helpful to you guys. Let's see what else. I am happy to do office hours by Zoom. So, you know, I had been holding office hours on Thursday mornings. I'm happy to, you know, I've turned that off for now, but I'd be happy to set up a standing office hours that you know, I'd put out a Zoom link and you could just click on it and join in if you wanted to. I'm also happy to meet with you offline, you know, individually. Just send me an email and we can set up a time. So let's see, while we're in class, so like right now, if you haven't used Zoom before, there is a chat function down in the bottom middle of your screen. So if you're looking at the screen right now, you should kind of be able to see, like, if you move the tools may go away, but if you move your cursor around on the screen where the video is, some tools along the bottom should pop up, like mute and stop video, which apparently most of you found already because you've shut off your cameras. If you kind of go to the middle, there's a chat function, and you can click on the chat, and you can type "hello class," right? And so so you can chat to me if you don't want to ask a question verbally, this will be an option to you. Um, so as I'm going along, if you have questions, feel free to use that function. I'll try to keep kind of looking over to make sure to see if folks are having questions. I thought a simple kind of approach might be, if you're having problems or you're not following, just go ahead and give me a question mark, and I'll look out for that. Um, so if I see question marks coming in, or if I say something like, okay, does everybody have that? If you don't have it, then give me a question mark. You don't have to choose to send it to everyone. There's an option to, just send it to me. I think yeah, I mean, I have all of you individually, so I could respond to you individually. So if you're not getting something, go ahead and use the question. Just pop me a question mark. I'll kind of try to keep an eye out for it. If I'm going to be looking over here when I'm typing, but I'll kind of try to keep looking back over here to see if you're giving me question marks. If you want to, if things are going well and you like what you're hearing, you can, throw me a smiley face or something like that too, right? So there's like these, reactions like thumbs up, that I guess, I'm not sure how this all works. That's not showing up in the chat. You can give me a smiley face. That'd be, if you're getting it, you can give me that. That's helpful. To give me some feedback, because right now, like I said, I'm looking at a black screen, talking to a black screen. So I rely on your feedback in class, because I usually am looking at you to see if it looks like you're getting what I'm talking about. But with all your cameras off, I have no idea. So feel free to use the chat to kind of give me some feedback. If I ask questions, you can, like I said, though, you can feel free to unmute and ask me a question as well. All right. Let's see. And then last bit of admin. I'll be doing those of you who are eligible to take the retake. You should have been getting traffic from me already, but let me just remind. So those of you who need to take the exam 1 retake, we'll be offering that on Friday morning. I believe I set 10 to 12 as the time. And then tomorrow I've sent an invite to those of you who could potentially be taking the retake for a review session with a Zoom link. So that'll be a standard review session. I'll be here, and I do not have an agenda. So come with, hey, I didn't get this, or I want to go over this kind of problem, for those of you who want to do that. Not mandatory, but available to those of you who are going to be taking the exam on Friday. All right. Any questions or concerns right now, just kind of on how we're going to go forward? So my plan is basically, I'm going to do the lecture I had planned to do in class. I'm going to do the best I can to replicate that, given the technology and where we're at. So any questions? Or we like, give me thumbs up if are you out there? All right, good. Thank you, Alexis. Appreciate it. All right, we got some smiley faces. Perfect. Thank you. All right, so you can hear me. That's good. Good to know. All right. So we'll jump into the material then. So we left off, we were talking about the impact of capital structure. So chapter 13 is all about capital structure, and capital structure is how the organization is actually financed. So I'm going to go ahead now and share my screen. So what you should see right now is my Excel sheet. If you can't see it, can you, I guess, give me a question mark. All right. So send me a question mark if you can't see it. Otherwise, or unmute and say, hey, I can't see it. Okay. So assuming all of you can see it right now, hopefully you're watching on something bigger than your cell phone. I'm going to blow up the size a little bit. Okay. So capital structure. So capital structure, right? We're working with a balance sheet. And the capital structures we have on the left side of the balance sheet, we have assets. And on the right side, we have liabilities and owner's equity, right? And so in class, right? So capital structure, the question is, how are your assets financed, right? So the assets, remember, is all your stuff. So the example we were working in class was we had current assets of 100,000, then we had property, plant, and equipment of 100,000 for a total of 200,000, right? And then we had let's call this firm A, right? Firm A had liabilities of 0 and owner's equity of 200, right? Well, let's call that owner's equity, specifically common stock of 200 for a total, right? Equals sum of 200. So the capital structure of firm A that we were talking about was 100% equity financed, right? So they had no liabilities. They were only financed by the money that the owners had contributed to the organization in the form of common stock. So over here is the stuff that they have, right? So they have current assets. Current assets, remember, just refresh, are assets that we plan to use in less than a year. So it's like cash, accounts receivable, inventory, things like that, right? And then property, plant, and equipment is our long-term assets. So property, plant, and equipment is one of those that could be there. And so we total up both the current and the non-current or long-term assets, and we get a total of $200,000 worth of stuff that the organization has. And then over here is who owns the stuff on the left side. So now I'm going to just copy this. I will post this spreadsheet that I use in class after I'm done so you can review. It might be a little messy, but I'll post it after the fact so you can kind of peruse it. All right. Option B, or firm B, or variation B, I think we were really saying this, like the same firm, just different forms of capital structure. Firm B had same or variation B of the same firm. I keep saying it wrong. Had the same current assets, same long-term assets for a same total assets, but we said instead of being 100% financed by owner's equity, we're going to be 50% financed by debt and 50% financed by owner's equity. And so liabilities, I guess I should call that debt, right? Some sort of debt financing. There we go. Make that a little nicer. Okay, so now we have a firm or a variation on our firm where we are 50-50 financed with half with debt and half with owner's equity, but we still have the same total liabilities and owner's equity of 200, right, as we did up here, and both sides still balance. Now, the thing to remember here is, the left side of the balance sheet is the visible side of the balance sheet, right? Nobody can, and it goes back to the example that I used way back when we were doing chapter 4 back in Finance 1, when we were talking about the balance sheet originally, was, if you're driving down the street and you see a house that you like and you go on Zillow and you see, oh, that house costs $500,000, right? That would be the equivalent of that's the asset value, right? That's the left side of the balance sheet, right, would be the 200. In the case of the house, it would be 500,000. What you don't see is the right side of the balance sheet. What you don't see is the capital structure, right, that the owner is using to occupy the house. And that capital structure would be a mix of a mortgage and some sort of, of owner's equity, that each of the, that the owners have. Every owner has a little bit different of a capital structure, right, or an amount um, uh, of uh, uh, of debt. How much are they in debt to the bank for, right? So with companies, it's the same way. And I don't know if you've been paying it. I'm sure you're watching the news to some degree, but there's been a lot of discussion about some firms needing bailouts, and probably the biggest one is the airlines right now. Well, part of the reason that the airline, we'll talk, as we go through this, I'm going to use the airlines as an example because it's a really good example of some of the challenges that we're going to talk about here. Because the airlines are very heavily debt financed. So like the airlines, I haven't actually looked at the numbers, but there's something like, their financial profile is something like 190 and 10, right? Where they have a huge amount of debt, and they're having to service that debt, meaning they're having to pay interest on that debt, even though none of us are flying right now. And so they've got this huge amount of debt that they have to keep paying interest on, and they're not making any money. And so we're going to work through an example here in a minute, looking at, how does that financial risk, how are they putting themselves at risk? It's called financial risk, right? How are they putting themselves at financial risk because of the debt structure that they have, where they're like, 95% debt financed? Okay, I'm going to return that back to our working assumption, but we'll come to that in a minute. Okay, so we've got these two examples that we worked in class, and I think I did an example C. I actually wanted to ask you, does anybody have their notes, what we said C was going to be, in terms of, if I had, let me copy this down. We were going to do an option C, where it was much more debt heavy. I didn't write it down because I kind of made it up on the fly. And it was going to be something like a much heavier debt ratio. Does somebody have okay, we've got a chat coming in. 160/40. Okay. Thank you, Mohammed. So it was like 160 and 40, right? So in this case, that would be, so we could do the debt ratio real quick, right? So the debt ratio would be the liabilities, total liabilities, divided by total assets, right? And total assets is the same as total liabilities and owner's equity by definition. So I'm just going to use that number. So here we have a debt ratio of 0.8. Here we have a debt ratio of 0.5, and here we have a debt ratio of 0, right? Because we have no debt. All right. And so here we have a debt ratio of 80%. What we're going to see is these guys, option C is taking a lot more financial risk. And we say they're taking more financial risk because they are taking on a lot more debt that they have to service, whether they're making money or not. All right. So we've got these three variations, and we're going to go ahead and look at. So we did this, a bit of this, but I'm kind of backing up and redoing it because we did it right before spring break. All right. So now I'm going to create another sheet. So this is my capital structure. I'm going to label this sheet capital structure. I'm going to create another sheet, and we'll call this the income statement. It's going to kind of be an abbreviated income statement. And we're going to have for option A, option B, and option C. Right? And we're going to assume they have some revenue, some operating costs, and that will lead us to our operating income, right? Then they're going to pay interest, and that will give us our taxable income. And then we'll have to pay some taxes because this is going to be a for-profit entity, and then that will give us our net income. All right. So make this all nice and neat looking. So our assumption was across the board, we were going to have 150,000 in revenues, 100,000 in operating costs, and that would give us our operating income of 150 minus 100 or 50, right? And then that's going to be true for all three options. So I'm just going to copy that over, right? Because it's true for all three. And why is it true for all three? Well, because um, this is the operating income comes from the assets. Zoom in. Okay. Yeah. Hang on. How's that? More? Okay. I'll try. At some point, I'm going to have to, I may need, well, let me see. I'll zoom in as much as I can and can get away with. All right. Pretty good now. All right. So the operating portion, right, this top portion is kind of independent of how the organization is financed, right? Because I think I said in the case of healthcare, normally we include interest in the operating expenses or operating costs. I should say expenses rather than costs. It's more proper. So in healthcare, we usually include the interest in the operating expenses. Every other industry I've ever worked with does not. And the reason they don't is because of what we're doing here, which is we're trying to separate out the effects of the operating portion of the business, which really focuses on the asset side of the organization, meaning how is we've given a bunch of resources to the management to go out and make us, make the shareholders money. And so how is management working with the assets that that they've been given by the shareholders? So the operating portion of the income statement really focuses on how are the assets being used. The uh, and and then the second half, right, when we get into operating margin, which we've talked about a bunch of times, really kind of just focuses on how well are the assets of the organization being used, and then the total margin or profit margin incorporates how the organization is financed. So in non-healthcare organizations, because the interest is usually in the non-operating expenses, the financing of the organization has a lot more impact on profit margin than on operating margin for non-healthcare organizations. Like I said, I'm not really sure. I've asked a few folks who are, senior finance people in the field, why do we do it that way? And the answer is just it's how we do it. So someday I'm going to figure that out and get a better answer. But for this chapter, we're going to pull the interest expense out of the operating expenses and put it into the non-operating expenses, which is why it's down here below operating income. Okay, so now we're going to assume well, now we're going to calculate the impact or the amount of interest that each of these organizations is going to pay. So this one, so A is going to pay, the interest rate is going to be 10%. So A is going to pay 10% on its liabilities, which is 0. B is going to pay 10% on its liabilities, which is 0.1 times. So just kind of pausing for a second to talk about what I'm doing in Excel, right? So I'm taking and I'm typing in a formula, 0.1, so 10% to represent the 10% interest that the organization owes, and I'm multiplying it by the amount of debt that they have. So variation B, in variation B, the firm has $100,000 in debt that it has to pay 10% interest on. So 10% of 100,000 is 10. So they're going to pay 10,000. Let's say this is thousands, $10,000 in interest. And then option C, also paying 10%, but on a much larger amount of debt. So they're going to pay 16. Right. So now, assuming that interest is the only non-operating expense that they have, we can calculate their taxable income. So their taxable income is going to be their operating income minus the interest that they have to pay. Right. So in this case, 50 minus 0 is 50. And then I can copy that formula over. And what I'm doing there is just, I just copy, because I've got a formula, I can copy it over, and you can see it goes D8 minus D9. D9 is the interest rate, right? And then if I go over here, it's E8 minus E9, right? Which is, again, the amount of interest. So we have 50 minus 0 gives us 50. 50 minus 10 gives us 40. 50 minus 16 gives us 34. Now, if we assume, let me just type that in there, that assumption, 10%. And then I think in class, I said the tax rate that this firm is going to face is 30%. So now the firm is going to pay, we're going to subtract off the taxes that the firm owes. So we're going to take 0.3, right, times, excuse me, the taxable income, which is going to be 15 in the case of option A. And I'll just copy that formula over. Okay, so now we have the amount of taxes that each variation of the firm is going to pay. And then we take, to get the net income, we're going to subtract taxes from the taxable income. And we get 35, 28, and 23.8. Okay, so I can even blow this up a little more. I think that's about all I can do. I need that space. All right. So we got this far in class. So I think and we got even maybe a little further, but happy to, I want to review this because it's a little tricky, right? So then we talked about return on assets, or ROA, right? So return on assets is is strictly the net income divided by total assets. So we're going to say, okay, it's going to be equal, in this case, 35. And I'm just going to type in, excuse me, 200 here, and I'm going to hard code it in just because it'll make it easier for me to copy across. So the ROA for option A was 17.5%. So 35 divided by 200 gives you 17.5%. I'm just going to copy that formula across. So we had 28 divided by 200 gives us 14%, and 23.8 divided by 200 gives us 11.9%. So at the outset, looking at this strictly from a return on asset perspective, option A seems to give us the best performance, right? And what does ROA tell us? Well, it tells us how much income did our management team actually generate, given the amount of assets they had to work with. Now, that's an important thing to look at, because it tells us an important part of the story. But what investors really care about is the return on equity, or ROE, right? Which is really the return on the amount of capital that the owners have invested. So going back to our capital structure, right? In variation A, we had a capital structure of 100% equity. So that means that the owners have contributed $200,000 in equity. In capital structure for variation B, they've contributed $100,000 in equity, and in capital structure for option C, they've contributed only 40,000. So there's a dramatic difference in the amount of capital that they actually have put into the business and that they demand a return on. So now going back here, I'm going to now say, okay, the ROE is the net income that the firm generates divided by the amount of owner's equity. So in this case, because the total assets equals the amount of owner's equity, there's no difference between ROA and ROE. And then we take 28, right, for option B, and we go grab the option B total, right? And that's 28%. And then option C, we only earned 23.8%, but we only had 40,000 in equity. And so let me turn those into percents. So whereas if you look at this from a ROA perspective, strictly speaking, return on assets. So looking at this as if, we're driving down the street and we're looking at that $500,000 house that we really think is really nice. And we look and we say, oh, it's $500,000, right? That would kind of be like the ROA version. Like we're not looking at the capital structure. But ROE asks us to look at how much capital is at risk, ROE, return on equity, which is very similar to ROI, right? And you could, it's not proper to say ROI in this case, but you could think of this as ROI, return on investment, because that's really what return on equity is. Equity is the amount of money that the equity holders have invested, the owners have invested in the company. And so what we've got here is called leverage, right? Or is the result of leverage. And leverage is the amount of debt that the organization has taken on. And so this amplified ROE is the direct result of additional of the amount of debt that the organization has taken on. We covered this to some degree in chapter 17, right? We did talk about ROA, ROE a little bit. And I think I talked about this last time, right? So when we do the DuPont analysis, right, we have the kind of the end state number is the ROE. And we look at the thing that can drive up ROE without any change in performance is the amount of the equity multiplier, which is really the inverse of the debt ratio. The equity multiplier, right, is the amount of assets divided by the amount of equity, and so the bigger that ratio gets, the less equity you have at risk. So you become a bigger. This would have a very C would have a very large equity multiplier. So the bigger that gets, it drives up equity, the return on equity, because you have less equity at risk. So it looks really cool right now for option C, right? So which option would you rather have? Well, you would, if you were an investor, would you rather get 17.5% return on your investment, or would you rather get almost 60% return on your investment? And the obvious answer is, of course, I would rather get 60% return on my investment. But is this a good investment? And the answer is, it depends, right? As most things do in finance. So let's now take let's see. How do I do this? We're going to take and consider risk. So we've spent a lot of time thinking about risk. Let's see, I'm going to copy this. And we're going to work with, for now, we're going to work with option A, right? And we're going to set up 3 possible outcomes with different probabilities. So we'll have a bad outcome, a good outcome, and a great outcome. And they will have kind of a mirror set of possibilities. So we have a 25% chance of a bad outcome, a 50% chance of a good outcome, and a 25% chance of a great outcome. We can even make these into percentages. And under the bad outcome, we're going to have 100,000 in revenue. Under the good outcome, that'll be our base case that we've been working with. That'll be 150,000. And then under the great outcome, we're going to have 200,000. Our operating expenses are independent of the outcome, right? So it costs us $100,000 to run our organization, whether we have a good outcome, a bad outcome, or a great outcome. So now we can just calculate our operating income, and it's the same as before. We've got revenues minus expenses gives us our operating income. So under the bad scenario, we wind up making 0 operating income. And I can just drag this across. Under the good, that's the one we worked with a second ago. The assumption there is we're going to make 50, and then under the great outcome, we're going to make 100,000. Now, under option A, we have no interest, so 0, right? And I'm just going to copy that across instead of bothering with the multiplication. Then our taxable income becomes our operating income minus our interest, right? And since we have 0 interest expense, 0 minus 0 is 0. We'll go across here, right? 50 minus 0 is 50, and 100 minus 0 is 100. We still have to pay taxes. So we're going to take 0.3 times our taxable income, and we pay no taxes when we make no money. And so our net income is our taxable income minus our taxes. Oh, and I didn't blow this up. Sorry. Oh, too much. All right. All right. Now we're out of control. Hold on. All right. And then I could just drag that across. So under bad circumstances where we're 100% equity financed, we wind up with 0 net income, which isn't good, right? Because we obviously want to make money, but at least we're not losing money. Under good, we get the same as we had estimated initially. And then under great, we make 70. So we calculate our ROA and ROE. So we get net income is 0. It's going to be net income divided by total assets. That's 200. And then ROE is net income. And in this case, divided by equity. In this case, that's still 200. So as before, we have the same ROE for good, and you can see we do really well for great. Let me see. I think I can just copy this over. So now we'll do option B. So the top portion is unchanged, right? So probabilities are all the same. So this firm faces the same probabilities, regardless of, right, operations don't change just because you've changed your capital structure. That's kind of one of the really important lessons to take away from this exercise is the operating structure or operations are tied to the conditions in the market. Your financial structure is kind of your choice. And so in this case, right, so they've still got the same amount of revenue, they still have the same amount of operating expenses, and so they wind up with the same amount of operating income. So down to here is all the same, right? And then, but then now we get into the interest portion, right? And so here we're going to pay 0.1, and under option B, we've got $100,000 in debt. Right. So they're going to pay 10,000 in interest regardless, right? And here's the key point, right? They've got to pay 10,000 in interest regardless of how their operations do. So this is where you're taking on financial risk. You are taking on when you take on financial risk, um, you have to pay, and that financial risk is really measured by the fact that you have to pay interest whether you have a good year, a bad year, or a great year. The interest is going to wind up being the same. And so now we have negative 10,000 in taxable income, 40,000 in taxable income, or 90,000 in taxable income. And you can see the effects here. Oh, I've got to change this. Sorry, the ROA stays the same. ROE is going to be different for this one because now we have 100,000 in equity, right? Remember that for B is half and half. So I'm going to copy this over and change it back to percent. So by comparison, right, we have the same results as before, right? 28 under good circumstances, it was 17.5 or 28. But under great circumstances, they really blow the doors off and they make 63% return on equity. The problem is that they wind up with -7 return on equity when things go badly. Now let me go back up here for a second and highlight an important point. So they have -10 in taxable income, and then they have -3 in taxes. Now this is kind of a complicated concept, and I'm going to try to. And this is not a course in corporate taxation at all, and it's been a long time since I've worked on those concepts. But the basic idea here is this. I mean, so you're -10, and then you get this negative. How do you have -3 taxes? So if a corporation has a loss, that loss can be carried back 3 years or forward up to 20 years. And that loss can then be used to reduce the taxes that they've paid either in the past 3 years, or they can carry it forward up to 20 years if they haven't made profit in the last 3 years. If they've had losses in the last 3 years, they can carry those losses forward and reduce their taxes that they owe the government in the future. So this is actually an asset to the organization. So it's kind of like Uncle Sam is giving this company, because they lost $10,000, right? It's kind of like Uncle Sam is giving them $3,000. So they're getting a credit that they can carry forward and use next year. So if next year they have a good year, right? And they would owe $12,000. So if this year they had a bad year and they had a $3,000 tax credit, and then next year they have a good year and they owe $12,000 in taxes, they could take the $3,000 the tax loss, apply it against this $12,000, and so they would only owe the government $9,000, right? So they would wind up with a net income of $31,000 in the following year. So that's why we treat it as if it was a kind of a where we're subtracting a negative. So we go from -10 to -7. All right, give me like thumbs up or a question mark if that doesn't make any sense, because I can't see you, and I don't know if you're just like I have no idea what Monica's talking about. All right, I see a thumbs up from one of you. Anybody else still there? Okay, smiley face. All right, I got a couple of people. All right, we're happy. We don't want to. Okay, good. So I can move on from that. All right, looks like, okay. Looks like everybody's gotten it, or those of you that are listening have gotten it. Okay. So that's something to keep in mind, is it is possible to have negative taxes. Okay. So if you have a firm that has a loss, they can have negative taxes, and that's essentially then gets added back as a credit, um, and therefore reduces the loss, reduces the lost net income. Um, so we've got these negative numbers. And so let me just copy over and we'll do option C. And I know you won't be able to see all of them all at the same time, but we'll do option C just to kind of finish this thought off. So option C, and like I said, I'll post this to Canvas when we're done. So what have we got to do for option C? We've got to acknowledge the fact that they don't have $100,000 in debt. They actually have $160,000. So we're updating the debt, the amount of interest that they pay. And then we've got to go change the ROE to 40 from 100, right? So I'm putting 40 in the denominator because the denominator is the amount of equity that the investors have put into the firm, right? So this is relative, right? The ROE is so the ROE is relative to the amount of equity, right, that the owners have at risk. So the capital structure in option C gives me 40,000. Right. So I've got less at risk. So by having very little equity at risk, right? My equity multiplier multiplies the impact of my net income. So I wind up with under good, like we had before, good is still 59.5, right? So under good circumstances, if everything goes okay, right, I wind up with a 59.5% return, which is pretty darn impressive, right? Um, if I have a great year, I really blow the doors off, right? And I get almost 150% return on my equity. So that's really impressive, especially when you scroll back over here to look at, the hyper conservative version, where I only make 35%. So which would you rather have, 147% return or 35% return? The answer is pretty obvious. It's, I'd rather have 147%. So, so now we've got to kind of think about, well, which of these would we want to own? And, that kind of depends, right? Again, it kind of depends. I'm trying to get this to lay neatly. It depends on how much risk you're willing to take on as an investor. So we're going to use our tools that we have studied in the previous chapter to think about expectations of the different three options that we have based on our financial structure. So just say one more time, right? This is literally the same firm from the outside, right? So like from the street looking on, right, this is the same firm. They're doing the same stuff. They're making the same amount of revenue, regardless of their capital structure, right? And so they make the same operating income, regardless of their capital structure. But when you get below the operating income, right, now you hit the effects of the capital structure are felt as of line 8, where we get into the interest, the percent interest. So that's where we get the amount of interest that we're having to pay. That interest impacts the amount of taxes that we pay, right? So there is a benefit, and we talked a little bit about this last Wednesday. There is a benefit to having financing, right? To having interest financing. It reduces our taxes. And not only does it reduce our taxes, but it functions as an amplifier for our return on equity. Now, if things go badly, it amplifies how bad it is, right? But it also really amplifies how great it is when things go well. So as an investor, the question is, can you can you handle the bad outcomes, right? And so I said a second ago, or not a second ago, but I guess half an hour ago, I was saying the airlines, right, are much more like option C. They're even further, they're even more amplified than option C. And they're having an even worse year than our bad option, right? They're getting like zero revenue, right? And they still have all their expenses. So we'll talk later in later in the course. Our last chapter gets into leasing, and hospitals do a lot of leasing. Healthcare organizations do a lot of leasing. They lease a lot of expensive equipment. They lease property. There's a bunch of different things with leasing, and you can talk to Jameson, and she'll talk to you all about buy lease decisions that she had to make as a as a CEO working with HCA and her other experiences, about whether you should buy or lease something. And so we'll get into that a little later. But airlines lease, most of them don't own their airplanes. They actually lease them on a long-term, what's called a capital lease, and we'll get into what that means. Like I said in I think it's chapter 18. Um, but you know, you've got to make these payments. Like Boeing, if you're flying 737s, Boeing expects you to pay your lease payments, whether you are flying that airplane constantly, or if that airplane is sitting in a hangar over at Logan. Boeing wants its money, right? And so, and then all the employees need to be paid in some way, or else, unless you furlough them. Um, and so, they're having a situation where, I mean, like, imagine right now maybe their revenues are like 25, right? And so this is what they're facing right now, is the equivalent of like a minus 160%. They're just getting crushed, which is why they're all coming to beg the federal government for a bailout. Um, so one of the, kind of to editorialize a little bit, one of the things they've been doing is, for the last 10 years or so, they've been doing very, very well. Airlines have been doing very, very well. They've been making a lot of profit. And what they've been doing is they have been using that profit, using the cash that comes into their organizations to reduce the amount of equity that they have outstanding. So they've been using that money to go out on the stock market and buy back stock from people like, well, maybe not you, but people like me, who maybe had stock in different airlines. And they've been buying that back, basically taking the stock off the market. And what the effect that has is they've gone from a capital structure kind of like this, where they were kind of mixed, to they've been using cash to reduce the amount of owners' equity, so that they wound up with a profile more like this, actually more extreme than this. Like I said, it's more like a capital structure of something like 90% debt. And so that's amplified the amount of risk that they've been taking. So when you hear people saying, objecting to giving bailouts to the airlines, it's because they have been what I would consider reckless with their capital structure. When you have a bad year, right? This is the an important lesson to take away from this. When you have a bad year and you're mostly equity financed, you just go to zero, no problem. When you have a bad year, um, uh, and you are heavily debt funded, you owe money to people, and you haven't made any money. You still have to pay out, right? So this option represents a lot more risk than option A. Okay, so soapbox off for a second on air, current events, but this is very relevant. Like what we're talking about right now is the hot topic in the marketplace. Is like, should we give bailouts to the airlines? Should we give bailouts to the cruise industry? Should we give bailouts to the hotel industry? Also a heavily debt finance. All three of those are heavily debt financed organizations. They have a lot of debt that they have to keep paying, whether they're making revenue or not. Okay. And oh, by the way, what does our president own a lot of? Say it. Put it out there. Hotels. Yay. Prize goes to Larkin. Good job. All right. So, not that he would allow that to influence him ever, right? Real estate. Oh, darn. Okay. That's all right, Jisoo. You're close. Okay. So, what we want to do now is calculate our expected ROE, right? So, this is kind of like our expected return that we had before. So, our EROE, right? And our expected ROE, so like is going to be based on our three outcomes, right? So we have in option A, we have a 25% chance of getting an ROE of 0. We have a 50% chance of getting an ROE of 17.5 and a 25% chance of getting an ROE of 35%. So what we want to do is a weighted average of the three outcomes based on their probability. So I'm going to take the probability of bad times the ROE under bad plus the probability of good times the ROE of good plus the probability of great times the ROE of great, right? So it's just a weighted average, just like we've been doing, just like we did in, I think it was chapter 10, right? When we were calculating the expected return. So that tells us that the expected return is 17.5% for option A. And then the beauty of Excel is I can just copy that formula over here. And the expected return, do that, is 28% for option B and 59.5 for option C. Now, this is not always going to be the middle number, right? You don't want to assume that for an exam. The only reason that this is showing up, that the expected ROE is showing up as the good ROE is because we have because we have a mirror probability. So that's why it works out that way. All right. So we've got our expectations, and now we can calculate our variance, right? And our variance, remember, is going to be the probability times the ROE, right, for each state minus the expected ROE squared. Okay, so that's what that is. So I'm taking E4 is the probability of the state times the actual ROE minus the expected ROE, right? That's what's inside the parentheses. And then this caret or tent shaped thing or up arrow or whatever you want to call it to 2 is the way that you tell Excel that you want to square something. So then I'm going to add 50% probability times the ROE, the expected ROE under good minus, I've got to get, this is causing me E16, right? So the problem I'm having is it's kind of covered by this raised to the 2 again, plus 25% times the expected or the ROE under great minus the expected ROE squared. Oh, I've got to change all these let's see, how do I'm going to do that? Because these are in percent, and we need to multiply all of them by 100. So otherwise, we get this super tiny number. So we want to get 100 times. That should fix it. There we go. Okay. So remember, when you calculate the variance, and you're calculating the variance of a percentage, you want to treat the percentage as a whole number. Otherwise, when you square the percentage, right, if you square something that is less than 1, it shrinks to an infinitely small, it gets smaller instead of bigger. And what we want with the variance is to actually make it bigger, right? So what I did by multiplying, right, by multiplying 100 times this, what I'm doing is I'm converting. So this first one was, well, that first one's 0 minus 0. That doesn't mean anything. What I'm converting with the, say the third one, or this would be 0 minus 17. So you'd wind up with minus 17% over here. This would be 0. This one's going to be 35 minus 17.5. So I'm taking 17.5%, 0.175 times 100 turns it into a full 17.5 instead of 0.175. Because if you square 0.175, you wind up with a really small number. But if you multiply it by 100 first, then it becomes 17.5. And then when you square it, it's 17.5 times 17.5. So it blows up the way we want it to. All right. So, and then to get the standard deviation, we do what? Somebody shoot it in there. What are we going to do with the to get the standard deviation? We do
take the square root.
Thank you. Get the square. I don't even know who said that, but thank you. Take the square root of the variance. So to take the square root of the variance in Excel, I'm going to raise it to the 0.5. Okay, so raising something to the half is the same thing as taking the square root. So you may not remember that. Oh, I saw it. Okay. Lots of responses. Thank you. It's good to see somebody, so a few of you are paying attention at least still. So, so the standard deviation winds up 12.4%. So let me just make this a little neater. Oh, hey. Those are not actually percentages. This is a percent. Let me see. What I want to do is reduce these zeros a bit. That's good enough. We'll leave it there. All right. So I have done the calculations for the variance. And now since these are all tied, they should just copy over. So without having to do without having to redo all that math, because the beauty of Excel is I don't have to do all that math again. I just copy the formulas. As long as the formulas are appropriately done, right, with the proper references, I can copy that over. So, so like I said, when the next exam you take, I'm going to assume you have access to Excel. I won't make you, I'm going to give you problems. You can do them manually, but if you kind of practice doing them in Excel, which I would encourage you to do going forward, you might be able to save time, right? You can see how fast I was able to do the variances for the other two and the standard deviations for the other two. So now we have the standard deviations for all three capital structures, right? So we have our base case where we're doing 100% equity financing. We have an expected ROE of 17.5 with a standard deviation of 12.37. With 50-50 financing, we have an expected return on investment of 28% with a standard deviation of 24.75. And then with a 80% um, uh, 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 capital structure or debt ratio, we wind up with a 59.5% expected return, but a 61% standard deviation. So remember, standard deviation is that bell curve shape that tells us over what range of possible outcomes are we talking about. Um, so the question is, which of these is better? Well, I mean, again, it kind of depends. It would be great to get a 59% return as opposed to a 17.5% return or whatever it was over there return, but you are riding a lot of risk, right? Relatively speaking, you're riding a lot of risk. So a tool that we can use to calculate risk to kind of express like, so, okay, how do I compare 17.5% ROE and a 12.37% standard deviation to a 28% ROE and a 24% standard deviation? Well, one way to do that is to use what's called the coefficient of variation. Coefficient of variation. And the coefficient of variation is simply the standard deviation divided by the ROE. So in this case, that's going to be 12.37 divided by 17.5. So we're getting a how much risk per unit of return are we taking on? And in this case, that's 70. It should be a percent. It's really a percent. So think of this as a percent. We've got some things expressed in different ways. We'd want to actually make this a whole number and then call it a percent. So we'd have 17.5% divided by 12.37%, right? We remember that the standard deviation, even though we're using whole numbers, this standard deviation represents a percent. So this is really 70.7%. And so carrying this over, the coefficient of variation here is 88%. And the coefficient of variation here is 103, 104%. So what do we do with that? That's not what I meant to do. I meant to wrap the text. There we go. So what do we do with 70%, 88%, 103%? Well, do you want a higher coefficient of variation or a lower coefficient of variation as an investor? And remember, it's risk divided by return. Right, so it is equals risk divided by return. Right, or I could just copy that down. So if the coefficient of variation is risk divided by return, and you're thinking as an investor, would you rather have a high coefficient of variation or a low coefficient of variation? You want a smaller, good, Peter. Low, small, good. Okay, so you guys are getting it. Those of you who are responding, right? You want a low one. You want a low one because the lower the coefficient of variation is, the more return you're getting for each unit of risk, right? So if you have a small amount of risk in the numerator, because it's risk over return. So the smaller your amount of risk relative to your return, the smaller your overall coefficient of variation is. So relative to its risk, option A has the best coefficient of variation. Now that said, that doesn't mean that you as an investor might not choose to go with the the more risky coefficient of, the more risky investment. But it is a way, the coefficient of variation is a way of measuring how much risk we're taking on. Okay. Let me see. All right, I think that's a good place to stop for today. We're a few minutes ahead of schedule. So we'll pick up here, pick up from here when we come back on Wednesday. I will go ahead and save this file and post it to, I'll create a module for, what is this, chapter 13. So I'll create a chapter 13 module. And what I'll do is I'll post both the spreadsheet that I worked on today to the module, as well as I think the easiest thing to do is for me to upload this video to YouTube, but I'll make it a private video so that you can only see it if you have the link. And I'll post this. So I'll post the video as well as the Excel spreadsheet that I just worked with to that module. Okay. All right. Any questions or burning topics for what we've covered today, or how we're shifting toward shifting? Hopefully this is okay. I think maybe after Wednesday's class, I'll send you a survey to say, okay, do we want to continue to drive on like this, or do you want me to try to do something asynchronous? Where you're, you'll just kind of move at your own pace. Let me see. Will we still be doing the chapter homework? How will we submit them? Do we still have homework? Okay, so questions about homework. Yes, I think I'd like you to still do the homework, and what you'll do is just take pictures of it and submit it online. Okay, so a few of you have done that for the chapter 12 homework. So what I'll do is I'll make it possible for you to just upload, pictures of your homework, or if you do it in Excel, you can just upload the Excel file, and I'll just take a peek to see if you've done it. So, so yes, still do the homework. It's still important to do the homework because I draw from the homework for the exams. Any other questions on finance? I think the dates that the homework are due are still accurate on Canvas as well. Okay, so seeing no specific comments or questions about finance, at the end of econ, I've got some announcements, some comments kind of about the internship and what's going, your internships and what's going on with that. So at the end of econ, I'll cut loose the non HMP folks, and I'll talk for a few minutes about what's going on with the internships and kind of where we are right now. Not a lot of new news, but I do want to kind of reassure you that we're working on things. But I'll talk more about that at the end of econ. All right. So seeing no questions, hopefully this was good. And I will see you guys at 3:40 for econ. All right. See you soon.